did you know that the instance of Google searches for when is the housing bubble going to burst went up last week 2,450%. People are looking all over the place for information about what's going on with the real estate market and when is it going to burst. I'm Shanna Welsh-Levin with SoCal Realty Law. I am your Southern California real estate attorney. And the purpose of this webinar today is to have a discussion about what is the Southern California residential real estate market like right now? Why is it like that? And when are things expected to change? As well as what do we think we'll see when the market changes? I would like to introduce you to my friend Bridget Potterton. She's a residential realtor with Keller Williams, and I've known her for many years. We've worked on some really tough cases together. She sells real estate, residential real estate. I'm a real estate attorney. We've had at least a couple of cases where these worlds collided. And so she gave this great presentation at our networking group a couple weeks ago, or I guess it was in March. And I was so impressed. I learned so much from it that I asked her to present that information to us today. I know there are other realtors on the call and you guys are all in the same boat. So I think you'll all kind of come together and understand what she's explaining. And for those of you who aren't real estate professionals, I think you're going to learn something that you'll find very interesting. So take it away, Bridget.
Thank you so much, Shanna. I just want to take a minute to say, for all of you, if you haven't had an opportunity to work with Shanna personally, she really is above and beyond. She is so talented. She is, I won't even go into the details of one case I referred to her, but the odds were against us in so many ways, and she just went above and beyond, and we were successfully able to close the case and make everybody happy. So thank you, Shanna, for your expertise, and I'm so grateful to know you. And hello, everybody. My name is Bridget Potterton. I am a residential real estate broker, as Shanna said. I know we've got a couple other realtors and brokers on the call. So my goal today is to give you some interesting information that hopefully will help you understand the market. I know we've got attorneys in different fields here as well. So I'm hoping that each of you will walk away with some nugget of information that you can use to help your clients, friends, associates when interested in buying or selling real estate right now. So let me just share my screen. Is everybody able to see my screen? Whoops. Hold on. All right. Are you able to see my screen now?
I could see it there.
Okay.
Yeah.
Perfect.
We can see it.
Okay. So the real estate market is pretty crazy. You don't have to be a real estate professional to have known that or heard that. But how crazy, you might wonder, is the real estate market? Well, most of you don't know me and you may not trust me, but I thought I'd introduce a friend of mine who you might know. My friend Snoop Dogg over here. So you yourself you might have heard, okay, yeah, the real estate market is crazy. Buyers have to go over list price if they want to be considered. So in case anybody in here is driving and can't read, it says the buyer asks, how high over list price do we have to go? And the buyer's agent just shows a picture of Snoop Dogg, who is clearly very high in the photo. So it's a funny one. We can all laugh, but the truth is that this is basically the reality of the real estate market right now. The market is crazier than it's ever been, that as in recent history. And Shanna had already mentioned previously about the bubble. People want to know about the bubble. Is this a bubble? When's it going to burst? But there's so many unique things that are happening right now in this industry that I wanted to kind of share. So I'm gonna stop sharing for just a second. I want this to be interactive. So I'm hoping you can. How many homes, detached and attached homes, do you think are on the market today? Type it in the chat. And while you're all typing your guesses, I will let you know that a normal market in San Diego County, a balanced market as we call it, is about 8,000 to 10,000 condos and detached homes. That's normal. We haven't had a normal market in about probably 7 or 8 years, where we have, a balanced market. It takes a little while to sell a house. There's not multiple offers on everything. Well, I will let you know. I'm seeing numbers from all over the board, from let's see, 800, yeah, some really low ones, up to 10,000, 200. Yeah, so great guesses. The correct answer is, as of this morning, there are 1,945 homes and condos on the market today. So based on the statistic that I just gave you, what that really means is that in this market, tomorrow, we could list 4 times the number of homes that we have today, and we still wouldn't have enough for all the buyers. 4 times. So let that really marinate for a minute as to why we have such a shortage right now and why things are so out of control. Shanna and I were speaking earlier. I don't know if any of you follow me on social media, but I had a client recently write an offer on a home up in Carlsbad. It was listed at 1.9 million. We offered a little bit over 2 million, knowing there was going to be multiple offers, and we lost out. Does anybody want to guess how high this $1.9 million home sold for? It was listed at 1.9. We offered 2. Yeah, great guess, Lisa. So the house went for 2.4 million, which is $500,000 over list price. And the crazy part is it really wasn't even underpriced. There were no comps to justify anything anywhere near there. And that buyer who ended up buying the house, it hasn't closed yet, but they're probably going to have to come up with, my guess is $300,000 to $400,000 in cash in addition to their down payment. And so that's just the crazy market that we have right now. This particular home that I have in the background is one I have in escrow, and we're in escrow 300,000 over list price. That's just the, and yeah, that felt like a bargain to my client who lost out after $500,000. But that's just the market that we're in. And the interesting thing is, normally we talk about the competition in our common market, which is the 500 to maybe 950. But the challenge that we're having right now is, even in that luxury market, we're seeing so many more people in that price point. So hopefully that will kind of help you understand exactly why we are where we are. So moving on from Snoop Dogg. So here's some interesting stats, and I know my graphs may look a little intimidating. Don't worry, I'm going to go through them a little bit, but you're going to get these as well at the end. So you can use these when talking to clients. You're welcome to use my slides. I have no problem with that. But what I wanted to share was the last 3 years of year to date. This is exactly what's been going on. My slides are always from the previous month. So this would be January through March of 2019, 2020, and 2021. Now, what I want you to focus on for a minute is just the orange lines here. The orange lines will show you that everything under 600,000, you're seeing quite a significant decrease in the number of solds this year versus last year. Does anybody want to guess why that might be? Why would that be? Anybody? You can type it in the chat. And if you're shy, that's okay too. You don't have to unmute yourself. So let's see, I'm seeing some chats. They're selling for more. That's exactly right. COVID, yes, that's another reason. Yes, our COVID market. So that is correct. Some of these price points, the $400,000, $500,000, $600,000 price points, are now moving up. Homes, a year ago, 15 months ago, that were in that price point have now moved up. So it is not surprising that we're seeing so few homes in those lower price points. The problem with that, as many of you know, is that is kicking out our, thank you to whoever is drawing on my screen here. I appreciate that.
Let me see if I can prevent that from happening.
I guess they didn't like my graph here. So essentially what's really happening is we're moving the the homeowners into different price points, which is good for them. The downside, obviously, is our buyers that can only afford $300,000, $400,000, $500,000 homes are no longer able to buy. And that's what's really squeezing people out, is these numbers right here. There's a couple reasons why this is happening. Number one, the pandemic. Yes, people have seen this as an opportunity to jump in the market. Number two, the rates are very low. Number three, I'm not sure if we have any commercial brokers on here, but I'm sure you can speak to this even better than I can. We have a lot of tech businesses that are hiring. I've sold homes just in the last 6 months to several people from Apple, Amazon. I've got an escrow right now with a family who's moving down here from the Bay Area there, and they're working at Facebook. So you have a lot of people right now in these tech companies that are making really good money, and that's where a fair amount of this money is. And then, of course, we always have international money coming into San Diego as well. The other people, of course, are our move-up buyers, the buyers that are selling down in the lower price points and moving up to the higher price points. And that's how they're able to afford it. They have enough equity from the lower price points. So let's go back to the actives. We talked a little bit about the solds for the last couple minutes. I want to talk about actives. So for those of you in here that are actively in real estate, either as an attorney or helping people buy or sell real estate in some way or another, these numbers are very helpful to see. Right now, if you are a broker and you have a client that can only afford up to, let's say, 600,000 only, I say only, like that's not a lot of money, but 600,000 or less, you can see there are very few homes. And this is the entire county. So if you have a buyer right now, or somebody, maybe a friend or a client that is thinking about buying a house, but they can't afford more than 600, it's probably going to be very hard for them. And that's the frustration. We have that lower starter market that is just being completely squeezed out. And even the higher price points, these are still very low numbers. So even my clients, I have a fair amount of clients right now between the $1 and $2 million range. And not long ago, that was considered the market. The luxury starter market was around $1 million. And that's not the case anymore. $1 million is not luxury. I would argue, I don't even know that 1.5 is anymore, just because the type of houses that are selling right now, it's just completely different. So lastly, this is something that you usually do not hear from the media. And so I want you to just bear with me for a minute while I talk about something called absorption rate. If you aren't familiar with absorption rate, it is essentially the number of homes that come on the market versus the number of homes that come off the market. So the number of homes that the market absorbs, that's what the absorption rate means. And this is such a critical piece of information that even if you don't ever want to look at my other slides again, highlight this particular slide, because this is what you're going to be able to use not only for your own interests in real estate, but for clients and whatnot. So I want to point out that if you look at the very bottom, I went all the way from $200,000 all the way up to 1.5 million plus. And you look at the absorption rate of 200, under 200, it's 138%, which almost seems impossible, but that's just because we don't have any more homes in that price point. That's just all that means. And at some point, that number is going to continue to go up, and then that market will completely disappear until our market shifts. But the numbers that I really want to explain to you is so a seller's market for absorption rate is any absorption rate above, I believe it is 20%. Anything above 20% absorption rate is a seller's market. So 2 years ago, we were at 40%, which was a good seller's market. Last year, we were in the 60%, which is an insane seller's market. And right now, depending on the price point you're in, I divided it out on price points so you could see, but most of them are in the 70s and 80s, which is unheard of, which basically means we are sucking up all the inventory we can. And even though I mentioned we have a few more homes for sale than we did before, there's more than enough buyers to suck it up where it doesn't even make a difference. It doesn't add anything to it. So if I can just leave you with one valid, good, helpful piece of information, it would just be keep your eye on the absorption rate. That's what's going to help you and your clients figure out what the next game plan is, if it makes sense for your clients to buy right now or not. I'm having some really tough love conversations with buyers right now about jumping in this market. And the reality is that based on this absorption rate, the market is going to get worse before it's going to get better. So if you have clients that are sitting on the fence, you probably want to show them something like this slide and explain to them, if you don't buy now, that's not necessarily a bad thing, but it's probably going to get harder in the next 3 to 6 months. So if you're not going to buy now, no problem, but let's look at maybe you getting into a long-term rental and maybe buying in 1 or 2 years when things start to potentially soften. We'll see. There's a lot that needs to be done for the market to shift. So again, I want to say thank you, everybody, for listening to a few minutes of my market update. I'm happy to answer any questions if there are any.
Thank you so much, Bridget. And we do have a couple minutes for a couple of questions, and then I think Bridget's going to stick around till the end in case there are some more questions. You answered my questions, probably because we had talked about them before the webinar started. I wanted to point out that there is some danger here for sellers who put the property on the market, enter into a contract, and then change their mind and decide they want to not sell. Because in most markets, Bridget, can you tell me, when that happens, usually what's the scenario and how do you work things out?
So unfortunately, I have had that scenario happen, a number of times in my 18-year career. And typically you can work it out if you have two reasonable people. However, this market is very different. You have desperate buyers who finally got their offer accepted, only to be devastated by a seller who changed their mind for whatever reason, whether it's valid or not. I had one happen in October of 2020 where my client changed her mind after we opened escrow, and she was just having anxiety. I'm not ready to leave my house. It's been 30 years. I just can't do it. And fortunately, I was able to work it out with the buyer and the buyer's agent without there being a problem. However, that is not always the case, right, Shanna? Sometimes there are interesting scenarios where that doesn't happen and they call somebody like you, right?
Yeah, so right now, I have this situation where under normal circumstances, as Bridget was saying, you would expect parties to work it out and not want to litigate over the purchase of a residential property, because the buyers, in the time that it would take to litigate over the property and the damages, the buyers can go find another property. And why would they want to spend money on attorney's fees if they can just go buy another property? But right now, and especially between January and April, I have a situation where a client was selling a property, signed a contract, and within 24 hours needed to cancel due to a family tragedy, and decided that, this was so sudden and so important. Obviously, anybody could see that they needed to cancel. So they went forward with cancellation, and the buyers who had already put in multiple offers on different properties, 5 or 7 offers, didn't get any of them, finally got this one into escrow, could not find another property for months. And during those months, interest rates went up. The prices, if you look at the price per square foot, went up significantly. And so now they're claiming $350,000 in damages because the property that they bought, which wasn't as nice as the one that they wanted, ended up being more expensive on a price per square foot basis. Their interest rate was higher, and over time, they calculated $350,000 in damages. It's a very dangerous situation right now for sellers to change their minds, and that is part of the market being the way that it is. So I'm going to jump into my explanation as to why the market is the way that it is right now, what we're seeing, what the trend is, and how is this going to change. So I'm going to change the spotlight. Thank you very much, Bridget. That was really super helpful. And then you'll be around for some additional questions. Are there any questions? Actually, I didn't even look. Yeah, let's do some of these questions. I'm sorry. So do you want to grab a couple of these?
Sure. Okay, so let's see here. Anne says condos on my street are selling for over list price. Great point, Anne. For most of the county, that is exactly what's going on, with the exception of downtown. Downtown has been slow for over 18 months right now, but with the exception of downtown, most markets are seeing that. Probably somewhere between 3 and 10% over list, depending on your price point in your area, is about what that is. John asked, do these numbers reflect US or general, or is this San Diego? Great question. So these are San Diego County numbers. And then I think, is that it? Oh, what do you think are some of the areas San Diego is sitting on the market? Oh, well, the areas like downtown that are sitting on the market, they were hit hard even before the pandemic. So I can't necessarily blame the pandemic, but I do know I've had several clients say, you know, Bridget, get me out of downtown. I'm tired of having to wear a mask just to leave my house. I think the other part is when you move to an area like downtown, you're buying a lifestyle. And for the last 13 months, these people haven't had that lifestyle. They're paying for walkability of the, you know, being near so many things, and there was nothing open. And so I think that's part of the problem. Besides that, also the homeless problem. I mean, without getting into the politics of it, the homeless problem is a major problem. In certain parts of downtown, it's worse than others. And sometimes I think people are they're just tired of it, and the problem's gotten so bad. And I think we're just, you know, at this point trying to fix it, but I think we have a long ways away. And I think people are hesitant with downtown for that.
Okay, I'm going to move on to the next topic, but we'll come back to these questions. I know there are a bunch of questions, and let me change the spotlight here. Okay, now it's on me. And so thanks again, Bridget. So some news on this market update and some interpretation. So one of the big factors in what's going on, what's locking up a lot of the inventory, in my opinion, is that there's forbearance. A lot of homeowners have forbearance with their lenders. They haven't paid their mortgage in a very long time, even going back to March 2020 when those forbearance programs were rolled out. So I have, there is a report from the Mortgage Brokers Association. This is a national association. They do have a California Mortgage Brokers Association, but I could only find the national report. The Mortgage Brokers Association reports on what's going on with servicers and lenders in the market. So as of March 29th, 2021, they report that between 2.5 and 2.7 million homes across the country are currently in forbearance programs. If a home is in a forbearance program, according to the CARES Act incentivized lenders to offer forbearance programs to borrowers when COVID happened. Those loans don't have to be reported as delinquent right now. So for borrowers who are in forbearance programs, they are not considered delinquent. That number, that 2.7 million number, is about 5% of the residential mortgages across the country. And then we have a number that I found online. It's not really a verified number, but an estimate of 5% of the rest of the residential mortgage loans are 5% are delinquent, meaning that the borrowers have not been paying their mortgages and they are not part of a forbearance program. So as of March 29th, 2021, the total loan forbearances dropped from 5.05% across the country to 4.9% of servicers' portfolio volume, and new forbearance requests dropped to their lowest level since March 2020. So that's good news. That looks like people are starting to exit forbearance. And I'm not sure if I define forbearance, but if you're not sure what I'm talking about when I talk about forbearance, I will explain it a little bit more in a moment. But we're also seeing that many landlords who have investment properties also continue to struggle with delayed rent payments that cause them to have trouble paying their mortgages. And for the most part, investment properties are covered by conventional mortgages, and conventional mortgages don't necessarily offer forbearance programs, although I do believe that many lenders are offering forbearance programs across the board. So many landlords are dipping into savings to keep their properties afloat, or they're delaying maintenance because they can't afford it. So I pointed out previously that in California, we have a statewide program for landlords to recover some of that rent at housingiskey.com, where tenants and landlords can both apply for some funding to keep those properties and keep the mortgages paid. Many of the forbearance programs that were set up by the CARES Act back in the summer of 2020 were initially a 6-month program scheduled to expire in September 2020. And then we saw that being extended to March 2021. And then this past February, we saw the March dates extended for until the end of June 2021. This means that a lot of homeowners have been able to extend their forbearance period for 12 months or more. In fact, many of them haven't paid their mortgage for 12 months. And according to FHA, U.S. Department of Agriculture, and VA lenders, those loans are all federally backed loans subject to the CARES Act. Those borrowers can now miss up to 18 months if they have a pandemic-related financial hardship and if they enrolled in the program by June 30th, 2020. And those programs are still open and can be applied for until June 30th, 2021. And I believe that the borrowers who apply by that cutoff date still get 180 days of time to enter into forbearance and be a part of a forbearance program. And then we have the Fannie Mae and Freddie Mac loans, which are federally backed loans that are owned or serviced by those federal agencies. They can miss up to 18 months of mortgage payments if they enrolled by February 28th, 2021. So that kicks those forbearance programs into August of next year, August 2022. But the majority of the loans that are in forbearance currently are actually conventional loans. Conventional loans are the ones that are not federally backed, that are not part of the CARES Act programs. So the borrowers who are taking advantage of those programs are at the mercy of their lenders and their servicers to basically take what they can get. What we have is, as of April, the Consumer Finance Protection Bureau has entered into this discussion, recommending that there be new COVID-19 foreclosure protections to prevent foreclosures and to require lenders to contact borrowers to discuss options to avoid foreclosure as a waiting period before foreclosure can begin. So the California Association of Realtors has indicated that the U.S. economy is positioned to grow at the fastest pace since the early 1980s, and mortgage rates are trending down again in the last couple of weeks. So realtors are feeling more optimistic about the upcoming home buying season. And meanwhile, what we see is with this bubble and the prices going up, housing affordability has gone down significantly, according to the National Association of Realtors Housing Affordability Index. So the Consumer Financial Protection Bureau wants to put some safeguards in place to ensure that millions of Americans are not forced into foreclosure as emergency mortgage forbearance programs wind down this year. The CFPB is proposing a new rule that would establish, as I mentioned, this temporary COVID-19 emergency pre-foreclosure review period that would essentially block loan servicers from initiating foreclosures until sometime in 2022. Again, the CFPB's authority is connected to those federally backed mortgages, but what we generally see is that where the federally backed mortgage market goes, the conventional market goes, because the guidelines and the recommendations that are made are beneficial to all. Preventing foreclosure is, believe it or not, is beneficial to the lenders as well, because the lenders incur a lot of liability if they have to foreclose. And so they prefer not to have to if there's any other alternative. I also want to point out that forbearance has to be requested. A lender does not have any authority to enter a borrower into a forbearance program or to extend a forbearance program unless the borrower has asked for it and agreed to it. They can offer it, but the borrower has to take the lender up on the offer. And so it's extremely important to talk to the lender. Anybody who is looking for assistance needs to reach out to the lender and make direct contact. So what is forbearance and how does it work? The general principle here is that if you don't pay your mortgage, you have to pay it back eventually. Nobody's just going to set you free and let you walk away from it. I'm going to show you part of the Consumer Finance Protection Bureau website that I downloaded in lieu of having my fancy slides that I usually like to use. So the Consumer Finance Protection Bureau website is very easy to find. And if you click around on there, you'll find this page about forbearance. And so forbearance is, by definition, where a person, a borrower, does not pay the mortgage for a specific period of time. It's temporary. And at some point, that borrower has to exit forbearance. There are many different ways that forbearance can be exited. Sorry about the formatting here. When I converted this to PDF, it didn't really format properly. But they list a few different options on the CFPB website. Option number 1, repayment plan. A repayment plan is where a person can now afford to pay their regular mortgage and then some. So they can start making the monthly mortgage payments again and tack on an additional amount that will eventually bring them current again. The second option is deferral or partial claim, where a borrower
Shanna, you're muted.
Okay, can you hear me again? All right, sorry, my
Yes,
phone
we can hear you.
cut out. I was using my phone audio. Is my audio okay?
Your audio is fine. We can hear you.
Deferral or partial claim is where a person can resume their regular payments but can't afford any increase in those payments, so they have no way of becoming current again. So with this option, the past due payments and the past due interest would generally be tacked on to the end of the loan or added as a subordinate lien to the home and would be paid back when the borrower either refinances, sells, or terminates the mortgage. Terminating the mortgage, in my opinion, that reference is to foreclosure, where the bank takes the house back and the loan gets paid back from the equity of the home. The third option mentioned here is modification. So if you were around in 2008 to 2014, like I know John Colwell and I were, we talked to a lot of people about loan modifications. And loan modifications were a terrible situation. Lenders are very difficult to communicate with. The process of loan modification is filling out forms and submitting lots and lots of documents to the lender, and then trusting the lender that they're going to go through those documents and make a determination to reduce the amount of the mortgage payment. So modification is the option for people who can no longer afford to make the regular mortgage payment. They have less money now than they did. And ultimately, lenders qualify the borrower for a loan modification. And if the borrower does not qualify for the loan modification, then they're out of luck. But there are lots of things that can be adjusted to reduce the payment by reducing the interest rate, by extending the loan from 30 years to 40 years. We saw all these tricks back in 2008 to 2014 of the ways that
that some of the lenders did work with borrowers and successfully get modifications to go through, but we also saw a lot of bailout money that was given to lenders to encourage them to do these. So to the extent that there may or may not be additional bailout money, we don't know. And then we've got reinstatement. Reinstatement is where someone can make a lump sum payment to bring all of those past due balances current and then begin the monthly payments again. So that's how forbearance works. That forbearance is where you miss the payments and then you exit the forbearance using one of these kinds of methods. So I will share this information, and at the end of this document, you can also go through each of, if there is a federally backed mortgage, a Fannie Mae and Freddie Mac loan talks about what those are, and then there are links to see what the terms that they're offering for exiting forbearance. You can see for FHA and HUD loans what is being offered to borrowers to exit forbearance, USDA, and VA loans. So this is a great resource. You can see down here for non-federally backed loans, these are your conventional mortgages. It just says check with your loan servicer for forbearance repayment options that they offer. The other reference that I found interesting was on the HUD website. On the HUD website, it says that you will not be required to pay a lump sum for the total missed payments at the end of the forbearance period. Your servicer will work with you on options to bring your loan current over time. I found that interesting because it doesn't qualify that statement. Conventional lenders aren't necessarily obligated by the government to do anything, but the Consumer Finance Protection Bureau is available for complaints against any lender across the board. So the recommendation is if conventional lenders or any kind of lender refuses to work with their borrowers exiting forbearance, report them to the CFPB, and you'll get that sheet which has the CFPB website, and there's a place online on that website to report lenders for not working with borrowers. So the big question is, what's going to lead to changes in the real estate market? And when will that happen? Obviously, I'm leaning on forbearance ending will cause a huge landslide of homes and borrowers who cannot become current again, who will need to exit forbearance plans by one of the ways that is not very appealing. That would be the loan modification or foreclosure. And along in those options, we have short sale. If the market were to drop, we would see short sales where the value of the property doesn't pay back the full mortgage, the full amount owed. So when those forbearances end, foreclosures are likely to begin, and foreclosures are currently in a moratorium. We're not seeing many or really any foreclosures at all because until July 1, for the most part, foreclosure is off the table for most lenders. I also predicted, and I'm not sure that there's any way to test this theory, but we had Proposition 19 in California, which changed the property tax transfer rule for qualified homeowners over the age of 55 or people who are severely disabled or who were victims of wildfire, who lost their homes in the wildfires, are able to transfer their low property tax basis to any other home in the state of California. So I predict that would have loosened up the market just a little bit. That went into effect officially on April 1st of this year. And so I suspect there are some homeowners who are processing that and thinking that they might move to another part of the state, maybe when the market gets a little bit easier. And then we have evictions that we've been on hold for a lot of the evictions for non-payment of rent because there is an eviction moratorium. We're not allowed to evict people who are not paying their rent right now, and that's going to change July 1 unless it gets extended again. So that will allow many of the landlords who have not been receiving rent to get new tenants in there and see if they can continue to keep the property. If they can't, then we'll see some of those properties coming on the market. And then loan modifications. Whenever we see loan mods, we see difficulties between borrowers and lenders, and then we see foreclosures if people are not able to work with the lenders. So I mentioned my experience volunteering back in 2008 to 2014 with the Department of Housing and Urban Development. We did these home clinics, which were mobile clinics. We went to the libraries all across San Diego County. We went to the Inland Empire. We went to Imperial County, and we did free foreclosure counseling, free loan modification counseling with housing counselors. And so I saw a lot of the fallout from the 2008 meltdown. And so I'm applying that experience to my prediction of what's going to happen when this forbearance period ends and we start seeing the foreclosures again. What you see is people who are desperate to keep their homes. You see people who become very prone to scams, and there are a ton of foreclosure scams that I can tell you all about because we've dealt with them, we've litigated over them. Fractional interest scams, refinance scams, reverse mortgage scams, tons of different things start happening to take advantage of people who are in a desperate situation. We would see changes in the law. The Homeowners Bill of Rights is flexible. It changes over time depending on the give and take between the consumer protection lobby and the mortgage lobby. So the Homeowners Bill of Rights in California gets strengthened and weakened depending on the need. So we would expect to see some changes there and maybe some new laws and maybe other laws like the Home Equity Sales Contract Act coming into play. My office will, I predict, become very busy with those kinds of cases. We'll see refinances and sales of properties because that's the easiest way out of a distressed property is just to get rid of it. We'll see bankruptcies. John will get busy. Bankruptcies to prevent foreclosure. I think the bankruptcy attorneys haven't seen much of an uptick yet because of the forbearance situation. But one way that's guaranteed to at least delay foreclosure is filing a bankruptcy. And if government bailouts are possible, if our government isn't stretched too thin to do that, then maybe we'll see some money put towards encouraging loan modifications. And then I think most interesting what we'll see is, you know, there was the situation in 2003 through 2005 where lenders really pushed the limits of loaning money to people who couldn't afford to pay it back. And that resulted in the market crashing, the home values going down, people being unable to borrow and unable to buy, a lot of foreclosures. And even though there were some new laws put in place to protect consumers from those types of lending practices that were going on back then, I do think that the lenders will push the limits of what they're allowed to do, because as this bubble grows and people want to buy, but they can't really afford to buy because those entry-level homes become more and more expensive, you will see lenders trying to loan them money, even if, practically speaking, they can't afford it. So you'll see interest-only payments. You'll see adjustable rate with a teaser rate, a low interest rate that increases over time until all of a sudden the homeowner finds that they can't afford the mortgage. So we have other things in place that should protect us somewhat from that kind of lending practice, but I'm afraid that the lenders will do everything that they can to give people money that people would be asking for, because people want to buy homes and they need to buy homes. So those are my theories. Those are my projections. I'm happy to answer some questions. And that's all I've got for you. And thanks again, Bridget, for joining us. And thanks to everyone for joining us today. I'm really excited to see all of you. And let's just go to the Q&A. I'll take my spotlight.
One question here from earlier.
View.
And it says, buyers' current behavior seems very irrational. Any thoughts on what is driving it? Is the average buyer too young to remember?
Go ahead, Jessica.
Sorry, do you hear me?
I had my volume down because I had my ear pods in. So
Oh, okay. So we have
now
one
I've
question.
got it. Now I can hear
Okay.
you.
We have a question in here from earlier, and it says buyers' current behavior seems very irrational. Any thoughts on what is driving it? Is the average buyer too young to remember 2008?
Huh, that's a good question. And I think that one might have been aimed at Bridget, but she had something else she needed to do, and she was gonna, oh, she's back.
She's
Okay.
here.
Hi. I agree with what you're saying, and things are a lot different from that original bubble. If you recall back in 2003, 4, 5, and 6, things got crazy. They were giving Mickey Mouse loans to everybody. And although Shanna did touch on that a little bit, I don't think that we're going to see that right now because our inventory is so low. Like I said, we need 4 times as much inventory for that to happen. So at some point, it does have to go down. It's when and if, it, like Shanna said, is it going to be a bubble burst or is it just going to be a correction?
Yeah, I agree, Bridget. I think people do remember 2008 to some extent, but that we're in a really different situation right now. In my predictions, I think it could return somewhat to 2008, and that would be a kind of a second layer of fallout. So we'll see the forbearance end, which is forbearance was not what was happening back in 2008. It was the loans, the bad loans that were happening back then. But I was predicting that maybe we'll see some bad loans again sometime in the future.
Thank you. And then we have another question here that says, when forbearance ends, do you think there will be a flood of homes on the market? Or a flood of Chapter 13 bankruptcies?
Oh, yeah. Good point. Well, I think that there will be a lot of foreclosures. And when people get into those that kind of distress, one of the natural reactions is to sell the home. So I would predict that the end of forbearance would result in more homes on the market. John, if you want to speak to Chapter 13 bankruptcy and where you think that's going to start fitting in, you're more than welcome to unmute if you can. Yeah.
Well, yeah, sure. And that's part of the anxiousness, right, to maintain the homestead. So Chapter 13 can be used quite aggressively to cure arrears over time. I mean, there's limits to how much of arrears we can throw into a Chapter 13, but found your comment interesting about homes going back upside down. We had a lot of people walking away and just going Chapter 7, straight bankruptcy, and living in their home without making mortgage payments for 4, 6, 8 months before the house actually foreclosed. So those were interesting times. I don't think we're going to have upside down homes for quite some time yet, but yeah, we're expecting Chapter 13s to ramp up because it's an effective way to protect the home and force a repayment plan if you can't get to the forbearance or the loan modification like you suggested.
Yeah, I would add it as a bullet point on the different ways that people can exit forbearance, because that seems like a reasonable way, if you can't work it out with the lender, that you'd force them to work it out with you through the bankruptcy law. Makes sense.